Don't invest in a business you don't understand. Wise words from the wise man, Warren Buffett. So before you invest your hard-earned money into companies making a beeline for the large street, it's important to understand your company. Know your company. This is CNBC-TV18's latest offering, IPO KYC. 10 questions and all the information.
Honasa Consumer is not just Mamaearth. It's a house of brands. Started in 2016 with Mamaearth, it now has 6 brands. Mamaearth, Dermaco, Aqualogica, Ayuga. These 4 were homegrown. 2 of them were acquired, Be Blunt and Dr. Shades. The company has a revenue of 1,500 crore rupees as of FY23, growing from just 110 crore in FY20. The company reported a loss of 1,300 crore in FY21, a profit of 15 crore in FY22, a loss of 150 crore in FY23, and then a profit again in Q1 FY24. 40% of the company's revenues go into ad spends.
The 1,700 crore IPO, which is offered at a price band of 308 to 324 rupees per share, looks to value the company at a little over 10,400 crores. The company will have a fresh issue of 365 crores, and the remaining will be an offer for sale from some existing investors. The company is asking for valuations at nearly 100 times 1 year forward price to earnings. Should investors bite in or stay out? Let's know your company.
We have with us none other than Varun and Ghazal. We're talking about Mamaearth, Honasa, coming out with an IPO. So many things going through your mind. But, everyone knows the company as Mamaearth. What does Honasa mean? And I see a Honasa tattoo on your hand as well, a mehndi tattoo.
A mehndi?
Yes.
Yeah.
I was attending a wedding function and we had to get mehndis. So what was on my mind came on my hand. But Honasa actually means honest, natural and safe. That's the first 3 words of each of the words that forms the name of our company.
For a lot of us, Honasa Consumer stands for Mamaearth. But it's so much more than that. It's a house of brands. You have 6 brands. So in just a few lines, can you tell us the business of your company?
So Honasa, like you said, is a house of brands. And now we have 5 more brands. We have the Dermaco, which is a brand based in scientific active ingredients for your skin concerns like acne, pigmentation. The brand has done phenomenally well in 3 years. It has clocked a revenue of almost, it's at an ARR of 300 crores. We also have Aqualogica, which is a brand based on deep hydration for your skin. And that brand has also grown phenomenally. It is at an ARR of 150 crores right now. And similarly, we have acquired 2 brands. All of them continue to grow very strongly. So yeah, 7 years, 7 brands now.
1,500 crore was your top line in FY23.
Yes.
80% came from Mamaearth.
Yes.
Can you give us the balance breakup of the other 5 brands?
So the other 5 brands, like Ghazal said, each one of them is growing disproportionately. And some of them were just 1 year old or 1.5 year old. Right? So I don't think it's fair to look at contributions. Right? But the fact that 3 of them are now more than 100 crores right? In just the last 3 years' time. Right? In a space where you have not seen even larger companies being able to create such sizable brands in such short period of time, right? Does talk about our capabilities as an organization, as brand builders.
So if we had to basically simplify your business, you guys are brand builders. You'll make brands which stand for stuff. You'll get the products manufactured from licensed manufacturers, and then you'll sell it to the market, right?
Yeah.
Online and a little bit offline.
I would add 2 more things, right? I think, we genuinely believe in the power of beauty and personal care category in India. And we believe that is going to be one of the fastest growing categories in FMCG in India. And disposable incomes and women joining workforce is a mega trend for India, because of which that category is growing the fastest. I think our focus on innovation and R&D, and we genuinely believe that while a lot of brands were serving India, and nobody was crafting for Indians, and understanding our cultural nuances, knowing our beliefs that, we like Multani Mitti, we like Ubtan, we use turmeric at home. And how can you create products based on these ingredients, right, which consumers will love? Using our R&D, using our innovation is something that we have excelled in, right? And that's what consumers love us for.
Perfect. You spoke about disproportionate growth for your ancillary brands, but as a company itself, the last 3 or 4 year CAGR has been upwards of 80%. Obviously, it's on a low base. Now 1,500 crores. At some point, the base catches up. The question is, what is a sustainable growth rate for you guys, say, 3 to 5 years down the line?
I think for us, what is going to be sort of, the desire and dream, and is to make sure that we continue to deliver better growths than the market, right? And continue to gain share. And so I think the aim will be to make sure that we outgrow the market and we continue to delight our consumers, right, by offering products that they really love.
And I think we are already seeing that, right? The way Mamaearth scaled up and the way we are now seeing a Dermaco take that same trajectory, or an Aqualogica, which is beating even the records of a Mamaearth and the Dermaco. The brands continue to scale really well and faster, and we've become more efficient in the process. And I think that's something that we are going to chase going forward.
Let's talk about the bottom line then, right? You had a loss in FY21, a profit in FY22, a loss again in FY23, and a profit in Q1 of FY24. So going ahead, is Honasa Consumer going to be a sustainable profit-making company?
So even if you look at the past, and if you remove exceptional items, and actually the company has been adjusted EBITDA positive. And, we have, of course, improved our trajectory. So from a last year adjusted EBITDA of about 3%, we have gone to about 7% about in quarter one of this year. And all of that is happening because when you scale up, and you see leverage starting to kick in. Right? Your marketing starts to become better, and you become more efficient. You need lesser marketing to reach out to the consumers because you have built awareness. Right? In our business of brand building, you need to first drive awareness. If people don't know what your brands stand for, why will they buy them? Right? So that's an investment that goes in. But as your brand scales up, right, the investment sort of starts reducing as a percentage, right? And which is what we are seeing. Right? And we hope that we will continue to demonstrate that efficiency as we scale in future as well.
You spoke right about the thing that was worrying me, that was marketing spends. You said that as you get scale, marketing spends as a percentage of sales do come down. For a company that does 70% plus gross margins, the EBITDA margins have been single digits. Why is that? Because when you were a 100 crore company, marketing was 40% of your sales. Now you're a 1,500 crore company, marketing was still 40% of your sales. Last quarter, you cut it down by 5 percentage points, and we saw that in your EBITDA. Immediately, your EBITDA came up by 5 percentage points as well. At what level does marketing as a percentage of sales start to reduce, stabilize, and when do we start seeing leverage? Because even at 35%, you all are 2-3 times the FMCG industry norm.
I would just like to say that this needs to be looked at as a journey of the last 7 years. This is a journey of building 6 brands at the same time. So while Mamaearth is 7 years old, the other brands are actually just 2 to 3 years old. Some are even younger, right? While this brand continues to grow and the leverage comes in, we are choosing to invest the money into building and scaling the younger brands that we have, right? And hence this ad spends and the percentage that you're talking about is actually a mix of, it's a sum of parts, right?
So you have a Mamaearth which is seen that leverage journey, right? But then you have 6 more brands which are much younger and have much higher percentage reinvestment. Right? Now, even with that sum, right, if we are able to go down, right, actually the efficiency journey is much steeper. Right? So is what we are seeing.
So what would the delta in terms of percentage of sales as advertising be for Mamaearth and all the other brands that you're investing in?
Of course, they're higher, right, by a decent margin because they're younger, but also take into account the growth factor. When you say that we have higher percentage reinvestments, and please also see we have significantly better growths than the industry. And we are continuing to gain share because that's what we want to do, right? We genuinely believe there is an opportunity out there for the taking. And we want to be that company which builds these brands and takes that share. And that's what we have been gunning for, and we've been able to do it. And that does require us, because we are competing with brands which might be 50 to 60 years old and already have that awareness. That does require us to drive that awareness, and we've been doing that. But like you rightly said, and it's a 70% gross margin business, right? So finally, as maturity sort of comes in, as things stabilize, it will flow through in the bottom line. We are just choosing to invest in growth.
So just explain the cost items for us. 70% gross margin. It trickles down to mid-single digit EBITDA margins. 40% goes for advertising. What are the other expenditure items for you? And which of them can be squeezed or can be used as margin levers? So we spoke about ads, but the others.
So there is marketing, there is salaries, right?
That's how much?
There is OPEX, right? About 10%, right? There is OPEX, right? Which is rents and all the other expenses, right? There is channel spends, right? We believe that the largest leverage would still come from the A&P bucket, right? But all the other also ends up being generating leverage as you scale, right? Is what we've been seeing, as we have sort of started on that journey. And I think over years we will get to see that even more.
And adjusted EBITDA margins are 7%,
yes,
right, in Q1. As the other younger brands achieve a steady state, what could be the normalized margins for Honasa Consumer, according to you?
Of course, they'll be better. Right?
They can only be
In
better.
double digit,
See, I think the right way to look at it, right, is that you see it, like you rightly said, from a gross margin perspective. Right? Amongst, if you compare to the FMCG peer set, we have amongst the best gross margins. Right? So over time, ideally, that should lead to better EBITDA margins relatively as well, right? And that's what we would like to work towards over the next 5 to 7 years.
EBITDA margins?
Not at this point in time, right? I think we will continue to get better. And why stop at that?
Why stop at that?
Teens.
Why stop at teens? We'll see how that goes.